Dave Ramsey is famous for his no-nonsense financial advice, but there's one thing he absolutely hates: ETF investing. But why? Could he be wrong about it? Or does he know something most people don't? Stick around, because today, we're diving deep into the Dave Ramsey versus ETFs debate and uncovering the best investment strategy for long-term wealth building. Hey everyone! Welcome back to the channel, where we talk about smart money moves to help you build wealth and secure your financial future. If you've ever followed Dave Ramsey, you know he's all about debt-free living, emergency funds, and mutual funds. But there's one type of investment he doesn't recommend: ETFs. So today, we're breaking down why Dave Ramsey hates ETFs, the real pros and cons of ETFs versus mutual funds, the best investment strategy for long-term wealth building. If that sounds good, make sure to hit that like button and subscribe for more money-making tips. Now, let's dive in. Dave Ramsey teaches personal finance with a very simple, beginner-friendly approach. When it comes to investing, he strongly recommends growth stock mutual funds with long-term track records. But here's where he has an issue with ETFs. One, he prefers actively managed funds. Dave believes actively managed mutual funds, where fund managers handpick stocks, outperform passive index-based ETFs. He often cites past performance of certain funds as proof. 2. He thinks ETFs are too passive. ETFs simply track an index like the S&P 500, meaning there's no manager making strategic decisions. Dave argues that good mutual fund managers can beat the market, while ETFs just follow it. 3. He's big on winning mutual funds. Dave always talks about investing in funds with a long history of 10 to 12% returns. But the problem? Past performance doesn't guarantee future results, and many active funds don't actually beat the market. For he overlooks expense ratios. Mutual funds often have higher fees because they're actively managed. ETFs typically have much lower fees, which means more of your money stays invested instead of going to fund managers. Now that we know why Dave dislikes ETFs, let's look at the real facts. Lower fees, more growth. ETFs usually have expense ratios below 0.1%, while actively managed mutual funds often charge 1% or more. Over decades, that fee difference can cost you tens of thousands of dollars in lost growth. Most active funds don't beat the market. Studies show that over long periods, most actively managed mutual funds underperform the S&P 500. If a fund charges high fees but doesn't outperform, is it really worth it? Tax efficiency. ETFs are more tax efficient than mutual funds, meaning you keep more of your profits instead of paying unnecessary taxes. Easy to buy and sell. ETFs trade like stocks, meaning you can buy or sell them anytime during market hours, unlike mutual funds that only trade once per day. So, should you follow Dave's advice or go with ETFs? Here's what smart investors do. Use low-cost index ETFs for core investing. Investing in broad market ETFs like S&P 500 or VTI Total Market is a solid strategy because they offer diversification, low fees, and long-term growth. Consider mutual funds carefully. If you do invest in mutual funds, make sure they have low fees and a consistent long-term track record. But don't rely on past performance alone. Stay consistent and invest for the long haul. Whether you choose ETFs, mutual funds, or a mix of both, the key to building wealth is consistency. Invest regularly, reinvest your dividends, and stay the course for 20 to 30 years. So, is Dave Ramsey right about ETFs? Not exactly. While mutual funds can work, ETFs offer a lower cost, more efficient way to grow wealth over time. What do you think? Are ETFs the best investment for long-term wealth, or do you prefer mutual funds? Drop your thoughts in the comments, and if you found this video helpful, don't forget to like, subscribe, and turn on notifications so you never miss a new money tip. Thanks for watching, and I'll see you in the next video.